This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Chapter 20 is split into two distinct sections. The first section, which I hope you have prepared for, is basically a revision of what we did in Chapter 12, dealing with, as you can see here, the following topics. We're talking about part disposals of assets, the classic situation, the company now as the individual taxpayer concerned. The company now has bought, say, a parcel of land for use within its business, but then what happens? It sells off some, but not all of that land. So what's your problem? You know what you've sold the bit for. What you don't know is the cost of that bit. Hence, we need some method of computing based on that's the total original allowable cost. How much of that should now be expended against this sale? That was the issue with part disposals. It was about establishing allowable cost. When we deal with non-chattel, now the definition of a chattel, which is a distinct area in its own right, is tangible, movable property. So if it's a non-chattel, it's not a tangible item. It's something like a copyright, which again we dealt with back in Chapter 12. The issue again there with a non-chattel wasting asset is as that asset wastes away, as it gets ever closer to the end of its life, clearly not looking at any other factors, but as the time goes by, if you've got something with a 10-year life as compared to a 20-year life, well, it's got half of the amount of life left in it as the 20-year one. So you'd expect, therefore, that it would cost you more to acquire the 20-year than it would to acquire the 10-year one. So what happens, therefore, in a capital gains calculation, if you buy one of these non-chattel, like a copyright wasting asset, if you buy an asset with, say, 25 years to run on it, and you sell it 10 years later when it's got 15 years still to run on it, then 10 of those years have gone. Hence, we need, when we compute our allowable cost, to depreciate the original cost in relation to the period of the ownership period that you had originally acquired. How much of that has wasted away? How much has now gone? Because I'm now selling something with a 15-year life. I'd originally bought a 25-year life. The cost we have is of the asset when it had a 25-year life. But if it's only now got 15 years to go, then we're going to have to depreciate that cost. So part disposals and non-wasting chattel assets, non-chattel wasting assets that we deal with, it's the same problem. That is, how do we establish the allowable cost to go into the capital gains or allowable capital loss calculation? We'll see how we deal with that. The area of chattels itself is, of course, another issue. Chattels, tangible, movable property. And again there, whether we're talking about wasting or non-wasting chattels, again there are rules which deal with it. Now I hope that, given what we said at the end of the previous session, that you've gone back and reminded yourself of these issues that are within Chapter 12. I think they're sections 4, 5 and 6 there in Chapter 12. If you haven't, then you need to go back and have a look at that and remind yourself about what those rules are when dealing with each of these three areas. Because basically in here, I'm not repeating in these notes the same technique. I'll revise these issues with you in this context. But the only difference that you will find is, well, no difference in the rules. It's just that in computing, as you know, a capital gain for a company, we've got indexation allowance to further reduce what would have been the chargeable gain for an individual. So the only new component here is we get an extra deduction in computing the chargeable gain, and that's the availability of indexation allowance. And by now, we should know, well, everything we need to know about indexation allowance, at least at this particular level for this particular subject here. The second section of this chapter brings in something new. We deal with either damaged assets or assets that have been lost or destroyed. Now, if you damage something, if you lose it, or if it is destroyed, the question then arises as to, did you have it insured? And if you had it insured, then there would be insurance proceeds. If we get insurance proceeds, what do we then do with those insurance proceeds? If it's damaged, do we use those insurance proceeds to repair, to put it back into its original condition? If something is lost or destroyed, do we use those proceeds to actually buy a replacement for what has been lost or destroyed? Depending on what we do, when those proceeds, if there are insurance proceeds, come in, are we going to calculate a gain based on those proceeds? Or are we going to be able to defer any such gain because maybe we put the money back in, i.e. to repair a damaged asset or to replace one that is either lost or destroyed? Now, these rules we happen to be dealing with here in the corporate tax context, and all that will mean is that in calculating any gain, yet again, we have indexation allowance to further reduce what would otherwise have been the chargeable gain for an individual. But the issues that we deal with in terms of those assets, damaged, lost or destroyed, they could be dealt with in a question again for an individual just as much as it could be for a company. So in the same way as these rules in section 1, we learned when looking at individuals and CGT, but now see that the same rules are relevant in terms of corporate tax and the chargeability of capital gains. In section 2, with those, to repeat, damaged, lost or destroyed assets, we could have done it back in chapter 12 as yet another section, and then we'd have just have to deal with indexation here. Well, we happen to be dealing with it at this point in time with indexation. If it came up for an individual, then it would be without indexation, but the rules are the same. Again, we've made that point several times now as we've gone through, where we're dealing, as we will mostly have to deal, I think, in terms of CGT, our corporate gains appearing in section A or B. Possibility of a bit of corporate gains maybe in the corporate tax problem in section C. But in which case, if it is an objective testing question, the first thing you need to sort out as you read that question is who is disposing of what. A line I've used on more than one occasion now, but it is critical to your performance. Who? Are we talking about a company, as we are in these chapters, or are we talking about an individual, as we dealt with in chapters 12 to 14? So who is doing the selling? Who is making the disposal? Because the rules for individuals may differ from those that apply to companies, and certainly, of course, in the context of indexation. Clearly, again, as indexation is used in corporate tax, any indexation factors that you need to use would be given to you within the question. So that might be a bit of a giveaway that this is a corporate tax problem rather than a personal tax problem. But who is disposing of what? Disposing of what? Like here, for example, chattels. We look at examples that are, these are chattels, antiques, paintings there, items of jewellery. These are chattels. Now, we do the examples off the back of learning the rule. What happens in the exam question is they just present you with that problem. Here's an individual, or here is a company disposing of this painting. So is it individual? Is it company? What is that taxpayer, personal or corporate, disposing of? Oh, it's a painting. What is a painting? A painting there, I mean this in a tax context, not in an ethereal artistic sense there. What is a painting? That is a chattel. When I dispose of a chattel, a painting is not a wasting asset. It does not have a life of less than or no more than 50 years. Therefore, what are the issues that deal with chattels? And that usually comes down to, again, the fact that we have an exempt chattel level of £6,000, but we also then have the prospect, a very likely prospect, of having one figure of cost or proceeds below 6,000 and the other figure above 6,000, and therefore the special rules need to be applied. So here in this chapter, we've got revision of these older concepts. If you haven't recently revised, please pause at this point, go back to chapter 12, check out the techniques, then return, and we'll pick it up from here. If you have, of course, revised those subjects, then we can steam on and deal with this first section. Once done, we'll then go to pastures new, as they say, with the damaged, lost or destroyed assets, see what the issues are, see the techniques that we use to overcome those issues, and realising that as we're looking at it in a corporate tax context, indexation allowance will be available, as we keep saying, to further reduce what would have been the simple chargeable gain for an individual. But otherwise, the techniques and the rules remain the same. Again, who is doing the selling? First issue on any objective testing question that you have to sort out that deals with capital gains anyway. Right, assuming therefore now that you have already checked through and revised this first section's areas, the part disposals, the chattels, the non-chattel wasting assets, let's see what we need to do, and then you can get some practice at doing it, which will be the same exercises as we did before, but for a company rather than an individual. We know that when a company disposes of a part but not all of the asset, the company bought 20 hectares of business land and they now sell off 12 hectares of the 20 hectares bought. This is a part disposal. We know what we sell for. We sell these 12 hectares for whatever sales proceeds are given. We also know a cost, but the cost is of 20 hectares, not of 12. So some sort of apportionment has to be done to work out the allowable cost. So how do we deal with that? The allowable cost of the part of the asset disposed of is computed as we saw for individuals in Chapter 12, which hopefully you've just seen, taking the cost of the entire asset, so the total cost, and multiplying out by sale proceeds over sale proceeds plus a figure given in the question, the value remaining. The remaining value of the property you still own. So you there would have what is the original cost times what is the bit, what's the sales proceeds of the bit that you're now selling over those same sales proceeds plus value remaining. The same calculation will be performed for a company, but of course, in addition to what we normally do, get your net proceeds, take away the allowable cost. The allowable cost computed will then be available for indexation. So it's the allowable cost that we compute, not the total original, but the bit that we get at the end of this exercise, having worked the allowable cost. That is subject to indexation with exactly the same rules of indexation allowance as we've seen up to this point in time. Here therefore is example 1 for you to have a go at. What do you have to do? Calculate the chargeable gain on the disposal of the 2 hectares of land in March 2022. We're told ST Limited owned 10 hectares of land, which originally cost £26,000 in March 2013. ST Limited sold 2 hectares of land in March 21 for £16,000. Ooh, maybe that should be that should be 21 there, as I can see now. Sold 2 hectares of land in March 21 for £16,000. The remaining hectares were valued at £34,000 in March 22. Those two dates have to be the same. So whether the sale is March 22 or March 21 doesn't matter. But at the point that you sold these 2 hectares of land for £16,000, the remaining 8 hectares were valued at that price. These two dates need to be consistent. Whether it's 21 or 22 doesn't actually make any difference at all. So what have we got? We know that we have sales proceeds, sold 2 hectares, which originally cost £26,000, sold the 2 hectares of land for £16,000. There are your proceeds. What is your original total cost? There is your £26,000. We now have to work out, did I say we? You now have to work out what is the allowable cost. The allowable cost is that original cost of 26 multiplied out by the sales proceeds over the same sale proceeds plus the value remaining. We will then have to apply our indexation factor, of course. Clearly, there is no indexation post December 17. So to March 22 or 21 is irrelevant, therefore we don't need that. What we do need is to December 17. There is your indexation factor, 0.269, from when incurred through to as a latest possible date, December 17. That figure you will apply to the allowable cost. So over to you guys now to do the calculations on that, please. As I said, the only difference to what you did in Chapter 12 is having got the cost, then you work out your indexation allowance based on that allowable cost to further reduce the gain. Okay, here's our answer therefore to example 1, which hopefully again gave you no problems. What was the proceeds of what we sold? There's the £16,000. What was the original cost of what we acquired? £26,000. How much of that should now be allocated against this sale to give us this hopefully correct figure of allowable cost? What do? We take sale proceeds over sale proceeds plus value remaining. And that is the proportion that we use. We do not take a physical apportionment of, well, we're disposing of 2 hectares out of 10. What we do is we take a value-based apportionment, sales proceeds over sales proceeds plus value remaining. That will give us our allowable cost, take it away to give us what is now an unindexed gain on a corporate disposal. What is our indexation factor? Taken from the question, you just had to pick out the right one, and it's never, ever anything past December 17, so it's pretty easy, and apply it to that allowable cost figure. That then deducted gives rise to our chargeable gain. We know, of course, that any figure of indexation allowance cannot serve to, as it were here, to create a loss, and it certainly can't increase a loss there. But we end up still with a chargeable gain. Hence, part disposals. Back to our chapter, and the next section we deal with is that of chattels. A chattel disposal is also dealt with in the same way as for an individual, which again, I hope you've checked back recently, Chapter 12. But again, the availability in a normal gains calculation of indexation allowance. The issue about chattels. Chattels, tangible, movable property. We've got to distinguish those that are not wasting from those that are wasting. The ones that are non-wasting here are things like your antiques, whether that's a bit of furniture, whether it's a painting, whether it's an item of jewellery, whether it's a statue, whatever it might be there. Those with a life of more than 50 years. The rules that we apply. Well, let's see what we've got here. An antique table. Well, first of all, JM Limited. Now, this is all corporate tax, I know, but in an exam question, that's the first thing that you look at. We've got to calculate here the net chargeable gains or losses arising for JM Limited in what is hopefully this time consistently March 2022. Sold the following assets. Right, an antique table. An antique table, that is a non-wasting chattel. Cost £3,000, sold for £5,000. This is testing out your knowledge of the chattel exemption limit of £6,000. If you both buy and sell for figures of cost, figures of proceeds that are individually less than £6,000, 3 is less than 6, 5 is less than 6, then that is an exempt disposal. So there it is exempt. There will be no gain or loss to compute. It is exempt. Chattel bought and sold for less than £6,000. A painting, again a non-wasting chattel, had cost £2,000 in January 13, so again below the cut-off exemption limit of £6,000, but this time sold for £10,000. Again, typically what we see in an exam question is one of the two figures of either cost or proceeds being above and the other being below the chattel exemption limit of £6,000. So if we have bought for less than but sold for more than £6,000, that means that there are two exercises to do. Firstly, compute what would be the actual gain that arose. Sold for £10,000, bought for £2,000. That goes into your basic gains calculation. But of course, because it is a corporate gain that we're dealing with, based on that allowable cost, indexation allowance will be available. It was acquired in January 13. All these disposals are March 22, so the only dates we're interested in are dates to December 17. So what have we got? The February date there is irrelevant, the first one, because the antique table bought in February 2012 was exempt. This one, January 13 through to December 17, yep, that's the painting, so there is your indexation factor to use. So you do an actual gain calculation. But then we compare that with a maximum gain, where we take 5/3, 5/3 of, in brackets, the gross sale proceeds minus £6,000. So the excess of the gross proceeds over the chattel exemption limit. And that's a maximum. If the actual gain is less than that figure, we use the actual gain. If the maximum is the lower, well, we're going to use the lower of these two figures because this, as I say, is a maximum. So you will need, therefore, to do those two calculations and then take the lower of those two outcomes as being the actual gain for the company. Thirdly, an antique vase, again a non-wasting chattel, which had cost £8,000 in August 2002 and sold for £3,000. So now we've got it the other way around. This time we've sold for less than 6, but we bought for more than 6. There's going to be a loss. This time there's only one calculation to do, not two, as there was in that second point B there, issue of the painting. There's just one calculation. And what do? We deem the gross proceeds. All I've said here was sold for £3,000. What you may well have in an exam question is we sold for £3,000, but there were then selling expenses to also take account of I don't know, £100 or whatever. So what we do is where we sell for less than 6, but we bought for more, our what will still be allowable loss calculation will start with a deemed gross proceeds of £6,000, the chattel exemption limit. If we did have selling expenses, we would reduce those gross proceeds, that deemed gross proceeds of 6,000, by whatever selling expenses had been incurred to get net proceeds. Then we deduct allowable cost, and that will give us our allowable loss. And obviously what that will do by putting in a higher deemed gross proceeds of 6,000 compared to the actual proceeds, which here happen to be 3,000, is going to reduce the amount of allowable loss. Finally, a vintage car, which had cost £7,000 in July 99 and sold for £9,000. A vintage car. I'll leave that one to you. What do you think we deal with that? I wonder if we have revised this area back from our CGT studies back in Chapter 12. Okay, so pause at this point. You therefore complete the exercise here by establishing what gains or losses arose and therefore what net gain or loss arises based on all of those disposals. Over to you. Okay, let's see how we fared with this one therefore. The antique table, as we know, is an exempt asset, not exempt per se because of what it is. We don't have an exemption for antique tables. They are not exempt assets. The reason why we have an exemption here is because both the cost and the proceeds are both not exceeding £6,000 there. And it is a non-wasting chattel. That, therefore, is the reason for the exemption. It is not an exempt asset in its own right, unlike the last one that I left you with, which was the vintage car, where vintage doesn't matter, cars, motor vehicles for private use there, are exempt. That's on your list of exempt assets. Remember that definition of chargeable assets? All assets are chargeable unless they are specifically exempt, and that one, the cars, are on that list of exempt assets. So 2 of those are dealt with very quickly. We just got the 2 that require calculations, therefore. Firstly, the painting, which is the non-wasting chattel, where it was sold for... Oh, and we have a problem here with... Bear with me a moment. There we go. The painting, which was the non-wasting chattel, which was sold for £10,000, allowable cost £2,000, deduct our indexation allowance 0.285 times that allowable cost of £2,000 to bring it down to an actual chargeable gain of £7,430. There is your actual gain. Perfectly normal calculation of a gain. Proceeds, cost, less indexation, chargeable gain. But because we have a situation where, though it was sold for more than £6,000, indeed a glorious £10,000 there, it was clearly bought for a lot less than £6,000. So we restrict that to a maximum gain computed as 5/3 times the excess of, remember, the gross proceeds over the £6,000 chattel exemption limit. What does that come to? Well, hopefully it comes to 6,667. That is lower than the actual gain of 7,430. So this maximum gain restriction will apply, and that's the figure that we will use. The antique vase, yet again a non-wasting chattel, but as we said, this time sold for less than 6, bought for more. So we deem those gross proceeds to be the figure of 6,000, the chattel exemption limit. If there had been selling expenses incurred, as well there may be in terms of an exam question, then those would be deducted to derive net proceeds, as you would normally do. We then take out what is our allowable cost, that was 8,000, and that therefore gives us a capital loss. Put all of those numbers together then to derive your net chargeable gain, and hopefully in your objective testing question, one of the letters from which you choose has that as the answer. Tick, that's the one for you. Well, back to our notes now, and returning to that section 1, there's just one more point to have a look at in this section, where we revisit themes that we've seen before when looking at CGT for individuals, and we now have to bring in, so what happens when it's a corporate disposal? And the only difference, as we've seen, is that in computing any chargeable gain, we have the availability of indexation allowance to reduce that gain. Otherwise, the techniques, the rules are exactly the same. In terms of this one, a bit of an odd one. This is a bit of a mouthful indeed. We're talking about a non-chattel wasting asset. Well, we know what a chattel is, at least I hope we do after what we've just seen. That is tangible, movable property. So if it's not tangible, it must be intangible. And a wasting asset is one with a life of no more than 50 years. So the sort of typical example we see, as we had when we looked at this area in CGT back in chapter 12, typical example is something like a copyright or a patent there. But a copyright would be a pretty typical one that you'd expect to see in an examination question. So, non-chattel, intangible, wasting asset, life of not more than 50 years, disposed of by a company. Again, as we say there, exactly the same technique, exactly the same issue, and that is establishing what is the allowable cost. You'll know what you originally paid for this wasting asset, but of course, as life goes by, as that life ticks away, the value is going to go down. And what that means is that we're going to have to depreciate the original cost, reduce it by a set amount based on the period of ownership that you, the owner, have had of that property as compared to the period of life that it had when you first acquired it. How much of that life when you first acquired have you used up? Because we're going to have to take account of that in establishing, as it always tends to be the problem with capital gains, the allowable cost figure. Again, I hope that prior to this you've checked out the notes again in chapter 12 there. And again, all it is, same rules as I've just said, just with indexation allowance. Just in case you haven't looked at it in the last few moments, let me take you back to that chapter 12 where we saw what the issue is. And again, as I've just said, it's about establishing what is the allowable cost. You're going to start with what was the actual cost, which you originally paid for this when you bought it. But it's then going to be reduced down to the allowable cost. The reasons, as you see here written in these chapter 12 notes, the allowable expenditure is deemed to waste away over the life of the asset as it gets ever closer to the end of its life here, then the value is going to go down. So to reflect that reduction in value, we've got to depreciate also on a time apportionment basis the allowable cost figure. How do we do that? Well, there's the calculation that we're going to use. What does that stand for? Well, firstly, this fraction here, P over L, that is simply the period of ownership of the vendor, here a company, back in chapter 12 an individual, over what had been the predictable life of the asset when we acquired it. So how much of what we bought has actually now gone? We have used it up. And we're going to take that fraction and multiply it out by, well, obviously, the cost of that asset. But that cost will in fact be reduced by any scrap or residual value that it may have at the end of its predictable life. Now again, examiners don't always put that in, but if you do see those scrap proceeds, that disposal residual value, then that is deducted from the original cost. So you get effectively a net cost of ownership. And what this calculation is, and I must repeat this because it's often a question that comes through in terms of Ask the Tutor forum there, it is to compute the allowable cost, the original cost must be reduced by, not reduced to, reduced by this calculation. This is the amount that we remove from the original actual cost in deriving what is remaining as the allowable cost. That is the figure then to fit into your gains calculation. Don't do this calculation and think, that's my cost. No, it's not. This is the deduction that you take away from the original cost to leave you with the allowable cost. And that we can see if we return to our corporate section here in this final example 3 in this particular section. So what have we got to do? Calculate the chargeable gain arising on the sale of the copyright, again the typical wasting asset that isn't a chattel here, in March 2022. So what are we told? Z Limited sold the asset for £38,000 on the 1st of March 2022. So we have our proceeds. On the 1st of March 2010, Z Limited bought a copyright at a cost of £25,000. So there's your original cost. This is the figure that we're going to base the depreciation on. It had an estimated useful life of 30 years. That's when we acquired it. But it's also got this estimated residual value of £1,000. So you know what the sales proceeds are, sold for 38. You know what the original actual cost was. But that cost has to be reduced by that calculation, that fraction that we have seen, where we know we're interested in, for the reduction, what is the period of ownership that this owner has had of that particular item, over what was the predictable life when acquired. Now we know the predictable life when acquired, that it had an estimated useful life of 30 years. And we know how much of that 30 years we have consumed. We bought it on the 1st of March 2010 and it's sold on the 1st of March 2022. We can see therefore how many years we have used up. There's your fraction to multiply out by the net cost. That's the original cost minus, of course, that residual, that scrap value of £1,000. Now, once you've got that cost figure, you do, as we did for individuals back in chapter 12. You compute the gain, but now that is for a company an unindexed gain. and therefore indexation allowance will be available to you. You'll get your indexation factor in the question. That's what happens here. Just one thing here, notice a bit of a typo, that the indexation factor is correct, 0.436. And of course we go through to December 17, but this intangible was acquired on the 1st of March 2010, so that should read from March 2010 through to December 17. But that's the figure that we need, 0.436. So over to you, therefore. Have a go at that. Pause now while you do that. And then when you've done it, come back and join us and we'll check through the answer and make sure no problems arose. Okay, let's again see how we fared here. Well, we know that the wasting acid here, the copyright, was sold for £38,000 and from which we need to deduct our allowable cost. The original cost was £25,000, but that needs to now be reduced by the fraction. How many years had we consumed? Well, from when bought to when sold. This again, if necessary, would have to be done to the nearest month. Here, of course, it's the same anniversary of the acquisition as is the disposal date. So it's a nice round number of years. We've consumed 12 of the 30 years of estimated life that it had when we acquired it. And if there were no scrap value, we just multiply that out by cost. But there is a small £1,000 scrap value here, so that reduces that actual cost. Effectively, a net cost is what we then are going to take our fraction of. All being well, 9,600 is the reduction, remember, and take that away, leaving us with the allowable cost figure. That now derives just for a company an unindexed gain figure, from which we deduct our indexation allowance, pick up the given indexation factor from date of acquisition through to, as almost inevitably it will be now in our exam questions, through to December 17, and multiply out by the allowable cost. Hopefully that number is correct. Put it through your calculators and check, of course. I'm sure you've already done it. And that leaves you with a bottom line chargeable gain, job done, in relation to the disposal of this copyright here. Okay, that means therefore that what we'll be doing in our next session, and our final session indeed, on thankfully these relatively short chapters for corporate gains here, looking at what is in fact not a revision and just application of something we've seen before to a company rather than for an individual. It's actually new to us. Again, we had to save something new for these chapters after all. And as you can see from that title there, it's when we deal with assets that have either been damaged or, more extreme, lost or destroyed. And very specifically, the issue is whether it's damage that has taken place and we need to return it to its working condition, or whether it's just absolutely destroyed or lost there completely, in which case we are going to have a gains calculation to perform if there are some insurance proceeds. If there are no insurance proceeds, then it may well be an allowable loss that we have to compute. But there will be insurance proceeds here. And the question is, how do we then do a gains calculation? If money comes in, then you can bet your life that HMRC will want some of that money if it's the disposal of a chargeable asset, a chargeable disposal by a chargeable person of that chargeable asset. They will want to put that through the tax system. So what we see is, how do we deal with that? If the asset we still have, but it is only damaged and we receive some money in compensation as insurance proceeds to spend on a repair, or what happens if it's an absolute loss? You will find that out, of course, in our next and final session on this chapter together.